In our last session, we have discussed about the fundamentals of financial management, and we have also looked into the historical aspect of financial management. Apart from that, in our last class, we have also looked into the functions of financial management. Now, as we know that there are three functions of financial management. One is investment decision, second is financing decision, and third is dividend decisions. Now, in today's class, we are going to look into that what are these uh, finance functions are, or what are these decisions are, or why these decisions are important in financial management. Now, let's come to the very first one, investment decision. Now, when we are saying investment decision, what we mean here is that how we are going to invest or where we are going to invest our scarce resources. Now, when we are talking about scarce resources, we are generally talking about the funds available in the hands of the firm. Now, as we know that cash is one of the scarce resources in everyone's hand, so it is not readily available to everyone. So we have to make a best and a proper utilization of these uh, resources, that is basically the cash. Now, the concept of investment decision relies on that. So what we used to do in a case of an investment decision, we basically look for a selection of an asset. Now, that means we are going to select an asset, and that asset must have a capacity to generate return for its investors. That means if we are investing the money in an asset, or if we are investing our money to buy an asset, then that asset must have a capacity to generate some benefit or some return to us. If a asset does not generate any benefit or any return to us, then definitely there is no point of investing in such asset. So in the case of an investment decision, the finance manager has to decide that what type of assets will be right for the organization to invest in. So the composition of assets, the type of assets, the assets which will have a different type of return benefits, that has to be taken into consideration by the finance manager, because the funds are rare in nature. We will not have, or we don't have a abundance of fund. So in the scarcity of fund, in the situation where we have a scarcity of fund, we must use our funds in a proper way so that we can buy right type of assets for the organization. And these right type of assets must have a capacity to generate some return for the organization or return for the firm. Now, when we are talking about investment decision, then we also have to look over that what type of assets we are talking about, or what classifications of assets we have. Now, in case of an investment decision, we classify assets into two types. One, fixed assets, and second one in current assets. So we know about the concept of fixed assets and current assets from our accounting classes. But the financial management has also used that classification for management of funds. Now, the investment decision which is related to fixed assets, that means when we are investing in any fixed assets, then we are calling it as a capital budgeting decisions. That means the decisions are totally taken to invest in long-term assets, the assets which are going to be used for a substantial long-term period. But whereas the investment decision which is related to the current assets, that means the assets which are used, or which are in use for a short term period, or which are used generally for a short term nature in investment, then we used to classify that particular type of investment decisions under working capital management decisions. So the investment decisions are bifurcated into two types. One, capital budgeting decisions, which is related to fixed assets, and second one is related to current assets, that is also called as working capital management decisions. Now, why these kind of investment decisions are important, and why these classifications are required? Now, we know that fixed assets and current assets have its own kind of characteristics. They are not same. They are not having the similar kind of features. So they are different in nature. So because of that difference in the nature of the assets, we must have a different type of approach of taking the decisions. So investment decisions lies on that. Now let us take an example in this case. For example, suppose a transport company is planning to buy a car, because as that particular company is dealing in a transport business, so obviously to transport the business or to run the business they need a car. Suppose there's a traveling agency, so they will buy a car. Now in order to buy a car there are two things. One is a fixed assets, that is the car, but at the same time to run that particular car there will be certain regular expenses which is again necessary in the hands of the company. Like there will be driver cost, there will be repair cost, there will be parking fees, there will be petrol fees. All these costs are also involved with that particular car. So it's not that the transport company is only going to invest the money in the car, but the company also has to take care of the investment or the amount which is required for the operation of that particular car. To run that particular car, what different additional cost will be required, that is also to be taken care of by the company. So that's why if a company is investing in buying a car, then we will say it as a capital budgeting decision. But the cost associated with running that particular car or operating that particular car will be definitely called it as a working capital management. So the investment decision is a very wider term in nature, because it's not that easy to take investment decision, because investment decision requires lot of scrutiny, lot of analysis, lot of observations and lot of study in that particular type of investment type decisions. Now let us come with the capital budgeting decisions. So what is a capital budgeting decisions? Now as we know that fixed assets are always a primary asset or a primary item for any firm from which a firm generates a profit. So every business wants to earn a profit. So that is the objective of every businessman. So obviously whether it is a small scale industries, whether it is a big scale industries, or whether it is run by a sole proprietor, partners or by companies, everyone wants to earn profit. Now to earn profit, definitely they have to do something. Now they will do something means they have to operate something, they have to produce something, they have to sell something. Now that must be done without the help of a fixed assets, it is not possible to do. So definitely to run their business, the fixed assets is always becomes a core component of a business organization. So when we are saying capital budgeting decisions, it basically relates with the selection of an asset which would yield benefit in future. So that means when we will start a business or when we will run a business or when we will do a business, we must understand that we will need a fixed asset. Now the question comes up here that what type of fixed assets we are going to select, which type of fixed assets is going to fulfill our needs, which type of fixed assets is going to give us a return, which types of fixed assets will have a significant benefit for us. So all these kind of ancillary questions will come into our mind when we are talking about selection of an asset. So the capital budgeting techniques, it is helping us to identify the right type of assets suitable for the business, and that will be possible only when we will follow up the pattern followed in the capital budgeting decisions. So capital budgeting decisions is very vital decision making in a investment decision. Now the questions are of this type, certain questions which may come into our mind, but these questions are not just coming into mind. There may be some more questions which may come into mind, like that which asset should be purchased out of different alternatives. Now as I was giving an example that the transport company wants to buy a car, but which car? There are so many cars available in the market. If you look over the companies selling cars, there are different cars in the market, there are different companies in the market, there are different brands in the market, there are different variants in the market of that car. So the difficulty comes here is that the businessman cannot buy all cars. The business needs only one car. But that one car will be what? It will be which car? So to select the right type of car, definitely the investor or the financial manager has to make a decision that which type of car is going to fulfill his or her requirement, or which type of car is going to fulfill the requirement of the company. So in that particular case, the decision of capital budgeting becomes crucial. In certain situations, we also have to decide that whether we will buy the car or whether we will give it on, or whether we will take it on lease. If we need a car for a short term purpose, the requirement is of a very short term nature, then definitely there is no point of buying a car to fulfill that short term nature. In that particular time of situation, we will definitely hire the car or we will take it on lease from some parties, so that we don't have to invest a huge amount of money on that particular car. So that also a matter of point of time. That means whether it is whether it is better to buy a car or whether to take the car on a lease or on a hire. So it may be of that type. Or suppose if we are producing a car or if we are manufacturing a car, then the car will need different type of components. There are so many components required to manufacture a car. Now, the components whichever is required in a company or in that particular car, are we going to produce all those components? Now, is it possible to manufacture all the components? Whether it will be cost effective to manufacture all the components or not. That is also an important element to look over. Now, there may be another options available to us. Rather than manufacturing the components, it may be better to buy from someone and assemble it with the car. So even if you look over a car, there are so many nut bolts, screwdrivers and seat covers and all these small elements, wires, all these things are required. Now, is it possible to manufacture all these things by the company? So rather than manufacturing those things, it's better to buy from some other producer and assemble it with the car. So those decisions are, which one is cost effective? Actually, that is a question, that which type of processes will be more cost effective, whether manufacturing will be more cost effective or whether buying it from someone and assembling it is more cost effective. So the financial manager has to look over to that type of decision also in a very clear way in the case of a capital budgeting, because finally the fixed asset is going to generate the return for the company, or the fixed asset is going to earn for that particular company. It is going to give a return to the investors. But if the fixed asset is wrongly selected or is not properly selected, then in that situation definitely the company will not able to earn profit or company will not able to generate profit from the firm. So the reason for this is that capital budgeting is important, because capital budgeting helps us to know about the different type of selection process which we can apply when we are going to invest in a different type of fixed assets. So that lies the concept of the capital budgeting. The basic objective of capital budgeting is what? The primary objective of capital as a budgeting is to identify those type of assets which are more worthy than their cost. Obviously, every item will have its own cost, but at the same time, every item will have its own benefits also. Now, the question here is that we have to make a cost and benefit analysis. Whether cost is more than benefit or whether benefits are more than cost, that has to be taken care of. So depending upon this cost benefit analysis only, we are going to invest in a particular fixed assets. So obviously in such kind of situations the risk is associated there, the risk will be involved there, and because of that particular risk the decision making for capital budgeting becomes very much crucial or very much important. Now, in case of an investment decision, there is another element of classification or a bifurcation, that is a working capital management. Now, when we are saying working capital management, means we are basically talking about the management of current assets. That means management of short-term nature of assets. The assets which are assets, but at the same time they are basically short-term in nature. Now, what is the importance of this particular element is that it has a tremendous potentiality to impact the liquidity and solvency of the firm or the profitability of the firm. Because every business is basically intending to earn profit, but earning profit is one way, but having liquidity and solvency is another way. So the firm has to look over that which type of management for current assets is vital for the organizations, because having too much of working capital is also not good, and having too short of working capital is also not good for a firm. Let us take an example in this case, inventory. Suppose an organization is dealing with manufacturing something, and to manufacture the items they need some raw materials. Now raw materials is an inventory for them. Now these inventories are definitely going to be maintained properly. Now too much of inventory will affect what? Production process, or it may lead to the damage, it may lead to wastage. If there is no demand in the market, if there is no demand in the market, then the whole production process will get affected because of the less demand. And because of that less demand, there will be less sale, and less sale will definitely lead to the profitability impact. But at the same time, this particular phenomenon is affecting the production process. But if we have a too much of stock in our hand or too much of inventory in our hand, then definitely that inventory is again going to be misused or underutilized. They will be not properly utilized, they will not generate the adequate return in that case, or it may go to the damage and spillage, or any kind of other things may happen with that kind of raw materials. So the problem lies there is that the raw material, if we have too much of raw materials, it may lead to damage, spoilage and all that thing because of this another factors or other factors. But at the same time, if we keep too shortage of, or if we have a too less inventory, then also our production process may get impacted. Then also our selling ability may get affected. Because finally, if our production is affected or if our selling ability is affected, it is going to affect our profitability. So the firm has to look over a balance between the inventory in both the sides. It should not have too much of working capital and it should not have too less working capital. That means the inventory. Having too much of inventory in hand is also not good for the firm, but having too less inventory is also not good for the firm. So the firm has to make a proper balance between these type of items. It happens with not only with inventory, it will also happen with cash. Having too much of cash in hand is going to lead to a loss of interest or loss of earning interest or loss of earning some benefits. But at the same time, that cash will be idle in hand if we have too much of cash in hand, or it may be misused or it may be improperly utilized or spent if we have too much of cash in hand. But at the same time, if we have a too less cash in hand, then we will lose some business opportunities in future. Because in that situation, in any kind of opportunistic situation, we will not able to take the opportunity because of too less cash in our hand. So as an investor, we have to maintain a right balance of cash also in our hands, so that we can able to manage the day-to-day operations of the business in a proper way. So there is always a conflict between the excess and the shortage part. So there should be a proper mix between the items whenever we are talking about working capital management. Now, apart from that, sufficient working capital has to be maintained. Sufficient and adequate working capital is always essential for the firm. But that is a big question, that what is sufficient? The word sufficient is very, very vague in nature, because the word what is sufficient for me may not be sufficient for you. The term will differ, the meaning of the term sufficient will differ from person to person, or will differ from firm to firm, or will differ from organization to organization. So how we will define the term sufficient here? So obviously for that there should be some mechanism in the hands of the firm or in the hands of the financial manager to decide. So there lies the basic challenge in the hands of the financial manager for management of working capital. So the working capital management is again a very, very important investment decision, which is basically related with short-term investments like current assets, where we have to look over the day-to-day requirement of a firm. Now, that is what we are talking about, that having too little fund is also risky, and having too much fund is not going to generate return at times. So definitely these are the challenges which we have to look over whenever we are talking about the working capital management aspect. Now, let us come to the next element of finance function, that is the financing decision. Now, we know that we are going to invest in our fixed assets and current assets. So, our investment alternative is clear, or investment decision is clear. But to invest in the firm, we need funds. So, obviously, the question comes and that what are the sources of funds? Where from we will generate the funds? Now, when we are generally saying sources of funds, we know that basically there are two sources of funds. One is own source, other one is borrowed source of fund. But we must be very clear that own source and borrowed source has its own advantages and disadvantages, and it has its own peculiarities. Both the type of funds are not similar in nature. Both are totally different, having totally different characteristics in nature. But it has a different impact on the performance of the fund. Now, in fact, if we run our organization only with the own fund, then there is a high risk by the investor, because there may be a probability of losing all the money if in a case the business does not run properly. So definitely, if we invest fully by ourselves, fully by own source, there is a too much risk on part of the shareholder or on part of the investors. But at the same time, if we run our organization on the basis of a borrowed fund, obviously borrowed fund does not come free of cost, it involves cost. So there will be interest payment, there will be some kind of other charges which we have to pay if we borrow funds from outside sources. So we have to be capable enough to think about that particular element also whenever we are going to generate from funds from outside. So the sources of funds in both the aspects are going to impact the performance of the organization. Because in this case, the profitability is the main element, but to earn a profit also need assets, and to have an asset we will need funds. So if we have a funds, then definitely we have to look over that which type of funding is better for us, whether it is own source, whether it is borrowed source, or whether it is a combination of both. But if we say a combination of both, then it could be anything. It could be from 0 to 100% anything. 1% own source, 99% borrowed source, or 2% own source, or 98% borrowed source, or it may be reverse also, 98% own source, 2% borrowed source, 97% own source, 3% borrowed source, or it may be 50% 50% own source and borrowed source 50%. So which one is right approach? With which type of capital structure, which type of financing, mixing of these financing is better for the organization? So there should be a concept of, there is a concept of optimal. So optimal structure is very much important for a firm, so that which generates profitability to the firm. So the firm has to look over to the proper type of financing mix or a capital structure whenever we are talking about financing decision. So whenever we are talking about financing mix, basically we are talking about the investment in equities and debt. So sorry, this is basically debt, DEBT. This is debt source. So the proportion of equity and debt is basically main decision in the case of financing. So as we know that equity is basically own source and debt is basically a borrowed source. So both the sources must have a proper balance in the firm, because if we don't have a proper balance or we don't have an appropriate mix between this, then it could have a crucial problem for the financing, for the financial organization. So in this case, a proper mix is required, a proper combination of equity source and borrowed source is required whenever we are talking about financing decisions. So the investor, the financial manager, he or she has to look over a proper method of decision, or he or she must come to a proper decision by looking over the right type of mixture between debt sources of funds and equity sources of funds. That means the borrowed sources of funds or own sources of funds respectively. So whichever the sources is going to, or whatever the combination between the two is going to generate the return, that is very much important for any business organization to look into. So financing decision is basically talking about that type of risk which is involved whenever we are talking about this type of decision, that is financing decision. Now there is a third element in the case of finance function, that is dividend decision. Now dividend decision is basically related to the decision where we are going to distribute the profit to the shareholders. Now here the idea is very simple. Here is that the company is generating funds, so the company is having funds and that fund is invested. So obviously that fund is invested in the business. After investing in that particular business, the business will earn what? The business will earn profit. Now what will happen with this particular profit? What we will do with this particular profit? So there will be two phenomena in this case. First, this profit will be reinvested into the business, so that means there is a reinvestment, that we will reinvest into the business this particular part of profit, or either we will distribute this profit as dividend to the shareholders. So we will give it as a dividend to the shareholders. That means whoever the shareholders are there, they will get a share of dividend from that. Now the question here comes in that which one is best, whether we will reinvest our money into the business or whether we will distribute dividend to the shareholders. Now both are having its own complications. If we reinvest our fund into the business, then shareholders will be not happy, because shareholders, every investor wants a benefit from our investment. So if an investor is not getting any return from the investment, then definitely no investor would like to invest in such kind of investment alternative, or they will not invest in the business. And if they will not invest in the business, the goodwill of the firm will affect, the market share of the firm will affect, the share prices will go down. So all those kind of phenomena will occur if a company does not distribute dividend to the shareholders. There is a likelihood. But at the same time, if a company distribute dividend to the shareholders, no doubt, no doubt, the market share will increase, the share prices will perform well, the shareholders will be happy. But at the same time, that the company will also lose a certain amount of money which is actually free of cost. Because if suppose there is some any kind of development projects is going on by the company needs money regularly. So it is always better to have the money from inside rather than taking the money from outside. Because if we take money from outside, if we can generate money from outside, it will be definitely borrowed, and if it is a borrowed source, then definitely it will have certain cost. It will not come free of cost. So if we need money to run our business operation or to expand our business operation, it is always suggested that you should always try to invest money from your own source. That means from inside. That means reinvest the profit whatever we are earning. So these kind of decisions gets complicated at times with the business organization. So business organization has to make a proper balance between these things, that whether it is better to distribute the fund to the shareholders or whether it is better to keep the funds within the organization, so that the organization does not have to depend upon outside sources. Because outside sources will generate some cost, outside sources will have certain expenses, but at the same time, if we keep the money with us, then shareholders may not feel happy about that. And if the shareholders are not happy about the organization, then definitely the whole goodwill and the market performance will go down. So these things are going to affect the whole overall performance of the organization, and the dividend decision concept lies there only. So here it has a very strong influence over the market share. So this type of decisions has a very tremendous potential to affect the overall performance of the firm. So affecting the overall performance of the firm has significant limitations for the firm. So to generate a good return in the firm, or to generate a good market share in the firm, of the firm in the market, and to have a good image about the market, definitely the firm has to take steps, and dividend distribution of dividend is one of such steps. But at the same time, once we will distribute the money will go out of the organization, and it will have it will be not going to again reinvested. So in that situation, the dividend decision becomes complicated and becomes crucial. So in this case, definitely the firm, the financial manager has to decide that how much of the profit should be reinvested back in the business, and how much it should be taken out in the form of a dividend, that is return on capital employed for the investors. So if we reinvest, definitely we are getting free of cost money. There is no other cost. We don't have to pay anyone, but at the same time, it will have an effect on the market performance. But again, if we don't distribute it, it will be if we don't distribute it, it will going to affect the shareholders' sentiments. And if we distribute it, no doubt shareholders will be happy, shareholders will be good, feel good. But at the same time, we have to depend upon outside sources for funds. So these type of effects are there whenever we are talking about dividend decisions. So dividend decisions plays a very crucial role whenever we are talking about the financial management part. Now, finally, in this particular session, if we can see that the dividend decisions are very crucial again in terms of increasing the liquidity, solvency, and profitability of the firm. And moreover, it has some tax implications. Dividend decisions has certain tax implications too. So those decisions are significant in nature. They have a significant impact on the performance of the business. The value of the firm is also affected because of dividend decisions. So as a shareholder or as an investor, we always like to generate more return from the company. But in order to generate more return from the company, the financial manager has to look into the elements of dividend decision. So finally, today we have looked after that what are the basic functions of financial management. And when we are talking about functions of financial management, we are primarily talking about investment decision, dividend decision, and financing decision. Now these three decisions are very crucial in financial management. Without these decisions, we cannot able to make a proper management of finance in an organization. Thank you.